Okay, hedging these micros today, the two different instruments. I took some trades last night, and we had a decent little spread on it, and so I didn't want to hold overnight for some reason. Glad I didn't because I was short biased, and although I was okay on the first two trades because I was awake, it did reverse and go long, and it would have hurt me a little bit more than I wanted. But we were able to put down, a $40 spread and made $40. Okay, so being long on one micro and short on the other, that's what we're doing again today. Right now, long biased. I'm long biased because I like the pintail daily chart overnight kind of look here. I like what this looks like. It's above previous day's lows and a nice strong pintail. Now, I've seen that before where it just comes crashing down, turning red, and going into a giant red candle and continuing down. So I'm glad I had that experience, and I know that that's possible. But since I'm long biased, I'm positioning myself with my hedge, my micro hedge, to be long with the unbalance of heavier on the long side. What that means is that I'm not equally balanced in my hedge. A hedge can be 100% balanced on both sides, as much as possible, I should say. And no matter how much it goes up, the same amount's going down. I don't want that. I'm willing to take losses on my trades because every loss, every strategy eventually will have a losing day, a losing trade. It's impossible to not lose. I'm not trying to have a perfect balance. I'm trying to go with my bias, which is long today. So that means I'm unbalanced to the long side, which means I'm heavier in my positions that are going long. Now, if it goes against me, I'm hedged, but not equally balanced, meaning I'm only going to protect some of that money on the downside, which will still be some profit. As you can see over here, when that started dropping, I was up $17. Now it's up 2. But if this were to take a tail down, and at some point it hits my maximum loss of $500, well, if I'm smart and able, this will probably be about $275, $300 with one micro if I let it go. If it goes straight down, crash market, and there's no time to adjust, no time to make changes, modifications, additions, then this will save me a lot of those losses. You see, that's why I like to do it. Now, the bad part about it is that if I'm right and it goes straight up and keeps going in a bull run, right? The same applies that if I'm up $500 over here, if I'm up 500, then over here I will be down the same amount more than likely. Oh, it depends though, because sometimes price moves slow and sometimes price moves fast, and you don't know how it's going to react. They're not perfectly aligned with one another, and it's amazing what can actually happen. Almost every scenario you can think of, right? To where even both sides could lose. Now I'm doing the MNQ over here, and I usually go long on it. Last night I was short the MNQ and long some MES, right? But typically, if I'm bullish, I'd like to be long the MNQ, and I'll start shorting because I've got a better experience with that, more trades with that, and I like what I'm seeing with that. I like kind of understanding how much this falls, one micro falls, how much it falls compared to one micro of the MNQ. I like the ratio, and that could change. Every day is different. I had a day where the MNQ just dropped and dropped and dropped, and the MES just stayed right there. I might have been down $2 or something, and this was down 137, right? So that can happen. But anyway, right now we're up 42 on this because I'm bullish, and we're down, it was about 27, okay? And that's what I want to see. I want to see a positive net value, that when I close both sides, I've made money on the trade. So let's see how this turns out. I'll let you know. Stay tuned.